What's up, guys? It's Rowan from AUDUSD TV bringing you another episode of the HSC Economics Review. Now, in this episode, I'm going to be doing a deep dive into the balance of payments and Australian dollar and some of the recent trends that have been occurring. Now, in particular, if you're watching this in the lead up to the HSC 2022 exams, one of the predictions we had for the essays, I did certainly in a niche from the AUDUSD team, was we thought that this was a likely essay topic. Now, Terry from AUDUSD also thought that it was more likely to be a short answer question, but either way, we have a strong feeling it's going to be featured in the paper, so it's a great place to do a deep dive. Now, you're probably wondering, where on earth is my co-host Terry today? We were shooting together, but Terry desperately wanted to go and pick up his PS5. You can see where priorities lie, so today is a solo episode. So let's dive in, and one of the first things I actually want to start with is the Australian dollar. The Australian dollar and the balance of payments are intimately connected, and at the moment, if we look at the Australian dollar data, it's sitting around about the 65 cents. Now, to give you a bit of context, it was sitting close to 72, 71 cents, roughly a month ago. Okay, so we've seen it drop rather quickly from almost 72 cents to 65 cents, and it dropped below into the 64s briefly as well. Now, note it was as high as 75 cents in April of this year. So we've really seen since April, a 10 cent drop in the Australian dollar. Now, I think it's important to understand why is this occurring? Like, why is the Australian dollar falling? Now, note that fall, it actually fell to 63.65 cents. That is a low. It's a 2.5-year low relative to the US dollar, okay? It's the lowest since April 2020. Now, remember what happened in April 2020? That was the beginning of really the COVID pandemic, right? The market started to respond to COVID and the news coming out of China and the spread, and there was a big collapse, and the dollar fell dramatically at that point. So we've got an interesting perspective here, right? That the dollar's at a level now as to what it was when the COVID pandemic began, but really we're in a very different economy and a very different global environment right now. Now, note, the important thing to highlight here is the US dollar index, though, rose to a 20-year high of 114.7. I'm going to talk more about that because that's actually really important to understand what is going on here. So I think, first of all, before we sort of look at why, I think the just quick thing to highlight is that if our currency decreases, right, we get increased cost of imports. And one of the problems we already have in Australia is with supply constraints and logistic challenges across the world. We're already experiencing imported inflation, right? Cost push inflation is occurring in terms of freight, the cost of, freight containers and fuel. And then on top of that, right, that's increasing the cost of imported goods to Australia. And then if our dollar falls, it jacks up the price even more. So the risk you have on one side of a falling dollar here is that it actually causes and can contribute to inflationary pressures. And we know inflation 6.1% for year on year. It was at 6.8, for the month, right? And it's expected to get to 7.8 according to RBA forecasts by the end of 2022. So you can see that the challenge then is a falling dollar can potentially, and I say potentially because we're going to come back and look at this, exacerbate some of those inflationary pressures and make the job a little harder for a central bank and the RBA to manage inflation. Now, on the flip side though, one of the positives at the same time is when you have a very low Australian dollar, it also makes the price of our exports a lot cheaper, which also makes them more price competitive internationally, which makes them more attractive for foreign buyers to buy Australian goods. And so on the flip side, okay, it also improves your international competitiveness. Now, it does mean though that we also need to think about how that plays out with something called our terms of trade. Our terms of trade simply refers to our export price index over our import price index. One of the things that has happened is while the dollar might have fallen, the Australian dollar, the commodity prices we've been selling have gone through the roof off the back of the Ukraine war in particular. So the good thing about all of this is while the dollar has fallen a lot, it's largely been offset by increased international competitiveness and increased commodity prices due to what's happening globally. Which has meant that that's actually offsetting and keeping some of the Australian dollar losses to a minimum. So if we actually think about how Australia compares globally, right, to sort of a G10, The sort of losses that we've been experiencing on the dollar relative to the US dollar, right, really place us about third, right? So you've got the Swiss franc and the Canadian dollar that have arguably outperformed Australia, and then the Australian dollar, and then you've got, the euro, the Danish krone, the New Zealand dollar, Norwegian krone, the Japanese yen, the Swedish krona, and the British pound, right? So we're third out of 10 in terms of our, how our dollar has ultimately been handling, okay, the decrease in our Australian dollar value. Now, in part, the reason this is occurring, and I think this is important to highlight, is not necessarily because of any structural weakness in the Australian economy that's scaring investors. It's fundamentally that the US dollar is actually rising. So the challenge here is not necessarily that the Australian dollar is falling due to poor performance, it's that the US dollar has increased, and it's increasing because the US Federal Reserve has been raising the US interest rates. And this goes to this perspective of interest rate differentials, a key driver in exchange rate value. So an interest rate differential is Australia's interest rate versus the US. If there's a negative differential, so our interest rate is lower than the US, right, or the US's interest rate is relatively higher to a number of other countries, so that we all have negative differentials with the US, or the US has positive differentials with everyone else, it means that the US is going to be attracting capital, right? People are going to wanting to be buying the US dollar and putting their money into US banks because they're going to attract a higher rate of interest. So what that does is it causes selling activity in the Australian dollar, purchase activity in the American dollar. And so that's the point where the Australian dollar relative to, G10 currencies is sitting third out of 10 in that, in a good way, in that sort of offset, right, with the US dollar. So in other words, the Australian dollar, yes, it's fallen, but it's actually been handling it a lot better than, a number of the other sort of countries in the G10. Now, as I said, that has a lot to do with our trade, and then that brings in our balance of payments, which is really, really important. Now, what I will highlight is on a trade-weighted basis, right, which measures the Australian dollar on a basket of global currencies weighted to our major trading partners, okay, it's broadly trading flat to levels at the start of 2022. So the point here is that, yes, the Australian USD dollar, relationship we've fallen, it's 10 cents down, right, since April this year. But actually, if we compare it to our major trading partners, it's pretty flat, which is a really big positive thing. And what that means is that the resilience of our currency is actually a factor that will mean that it's not going to cause as much of a headache for the RBA considering, interest rate policy rate decisions and the role that it could play in inflation. So that's good news, reduces some complexity on what is already a complex inflationary situation. Now, at the end of the day, what's occurring at the same time, right, is an expectation that there is going to be a projected concurrent recession in Britain, the Euro area, and in the US in 2023. ANZ and their economists have suggested this, okay? And so that means that there is an expectation the US dollar is going to continue to attract what's called safe haven bids. Okay, if you expect a global recession, right, there's a tendency to move back into, really safe currencies, and the US currency being really the global benchmark. And so it's going to largely probably see ongoing strength in the US currency, and as a result, ongoing potentially downward pressure in other countries' currencies, including Australia. But ultimately, because we are a strong energy exporter, okay, it's likely that we're going to see our Australian dollar remain fairly strong despite this. So there's some positive here. Now, what does this all mean for our balance of payments, and what is happening on our balance of payments? Important to understand, okay? Now, Australia has recorded its 13th consecutive current account surplus in the June 2022 quarter. Now, this is the longest period on record, okay? If we zoom out for a moment, over the 3 decades from the 1980s to now, Australia pretty much ran current account deficits equivalent to about 4% of nominal GDP. Okay, that was like a given. And the result of that was ultimately because of the savings investment gap, right? It was largely due to, a surplus of attractive investment opportunities in Australia in excess of Australia's national savings and our ability to fund those. And so therefore, we needed to access foreign savings to fund that in the form of foreign investment coming into Australia. So as a result, we saw savings exceeding domestic investment, driving the fact that Australia was a net capital importer. And this meant that we recorded a capital outflow, and ultimately, okay, what it meant was that we had, a current account okay, that was in deficit, and we had a capital and financial account that was in credit, in surplus, because we were importing funds. Now, ultimately, for a current account surplus to occur, that has meant, right, that we've needed to see a little bit of a switch of that, okay? Now, ultimately, actual sort of Australia's current account to GDP ratio was 3.2% in the June quarter. Okay, it was 1.3% in the March quarter. It was 2.3% in the December quarter. So, and it came off a 4.1% as a percent of GDP in the September quarter 2021. So it was starting to fall. Okay, and then it's kicked back up to 3.2, and we need to understand, well, why has that occurred? How has the dollar played a role? How has global conditions played a role in that? Now, a big driver in that is that in June we saw $43 billion in coal exports, okay? And over the 2022 financial year, it exceeded $100 billion of coal exports, okay? Now, the impact of that was significant. Impact was significant on a budgetary level, okay, in terms of the federal government budget. So we saw that the federal government budget outcome was, basically it was a forecast deficit of $32 billion compared to the almost $80 billion in April. So it almost has improved that, deficit by up to $50 billion, which is significant. Now, I think one of the key things that has been driving this strong current account performance has been strong export prices, and particularly commodity prices. So our terms of trade rose 4.6%. It is the highest ever it has ever been, okay? So to give you a bit of context, it's now sitting over 140, okay? During, really since, 2020, since the onset of COVID, it's been sitting pretty consistently over 100. But really, the only other time it's been over 100 prior to that was in the mining boom, around 2011 and 2012, okay? And it was it was about 110, 111 in 2011, 2012, okay? So we're sitting in like a terms of trade right now where our export prices, we're getting paid so much more for them relative to import prices than we've ever had before. And the good news about this is offsetting the fact that our Australian dollar has diminished to, 63, 64 cents, right? Ultimately, what it means is that prices for commodities have gone through the roof, largely due to, in particular, Ukraine, and just the global flow-on effect that's had on commodity and energy prices. So I think we can see overall that, it's had a really, our balance of payments is in an incredibly positive position. I think the thing that we sort of need to consider here as well is we want to dive in and maybe look at the BOGs, the balance of goods and services. So let's dive in. We looked at the fact that our overall current account, okay, was sitting at 3.2%. Let's take a little bit of a look at what our BOGs actually is. And so the BOGs, right, actually decreased. It decreased by roughly, 8.4 billion, okay? Now, ultimately, it has been in deficit, though, once again, for almost 4 decades, right? So the trade balance has now been in surplus. So the BOGs has been in surplus since late 2016. So it's been there for quite some time, and it increased to its highest level on record at 7% of nominal GDP in the September quarter of 2021. Now remember, that was also the point when the overall CAD as a percentage of GDP hit 4.1%. Now, most of that has been, primarily, being a result, as we've said, of the fact that we saw, just commodity prices. So to give you a sense, right, they're trading 50% higher than they did in 2016, okay? And a lot of that is because of the increases in prices in iron ore, LNG, and coal prices. Now let's also look at the net primary income deficit. So the net primary income deficit widened. It went from 24 billion it widened to 24 billion in the June quarter of 2022. Okay, now this deficit reached record levels because of some high dividend payments to non-residents, because profits are remaining really strong. We've got high commodity prices, and so even though our BOGs has improved, right, and it's in a surplus, which is great, our net primary income still is growing, okay? And you've got to remember that net primary income, traditionally, right, before we've had current account surpluses and BOG surpluses, traditionally it was about negative 3% of GDP. So it's traditionally been very large, and the reason it's been very large is because we're paying both interest repayments and, profit dividend repayments, but particularly both of them, but interest repayments particularly on accumulated debt and equity over the last 30 to 40 years, okay? So we've accumulated debt and equity, and as that figure grows, our interest repayments are also going to grow, and our dividend and profit repayments grow if we have strong economic growth on the dividends and profit side. Because we've had strong profit, even though we're in a low interest rate environment, those interest rates are going up. So the interest rates are going up, that's going to increase the net primary income deficit. And if we continue to have strong economic growth, we're also going to see that that's going to increase the profits and dividend repayments that are made. So we're going to expect really to see net primary income deficits continue to grow over the future. Now let's go take a look at the financial account. So we've looked at the components, right, of our current account. Now let's move over to look at the capital and then the financial account. So in terms of the financial account, okay, it increased by 11.3 billion to 18.7 billion in the June quarter. And most of that was a net outflow of equity and a bit of a net outflow of debt. So that means net outflow means overall we're investing more overseas and they're investing us. We're investing and lending more overseas to when they're investing us. And that makes sense because one of the shifts that's happened is that for us to have a current account surplus, it means we now need to be no longer a net capital importer. We need to be a net capital exporter, okay? And so you can see that a lot of that's been driven by that net outflow of equity and debt. Now, why is it then a deficit? Well, because we're sending money overseas, we're not receiving it anymore. And that's why it would have been in surplus before. So ultimately, you can see that the reason we have a current account surplus sitting in here is because we're ultimately exporting capital, right? And we also have here, a trade balance, that's in surplus, right, on our BOGs. Now, ultimately, right, the shift in the capital and financial account has contributed to a decline in Australia's total net foreign liabilities, right? Now, that's the total amount we owe foreigners less what they owe us. Now, liabilities is debt plus equity, debt being money that we've lent, right? Equity being money that we've invested, okay? And these are now at their lowest levels as a percent of nominal GDP in a number of decades, okay? So to give you a bit of a context, they peaked in about 2016 at about 60% of nominal GDP, and it's now declined to less than 40% of nominal GDP, its lowest since the 1980s. And that's because of that growing pool of domestic savings. So one of the ways that we might measure external stability, remember, is one, a CAD as a percentage of GDP, right? Instead of it being in negatives, it's in positives because we've got that surplus. Secondly, one of the things that we'll use to measure is also, our net foreign liabilities as a percent of GDP. And as a percent of nominal GDP, we can say it's gone from over 60% to below 40%. It's sitting somewhere around the 37, 38% at the moment. So you can see that, despite the last couple of years, actually in many, in the COVID recession, in many ways, a balance of payments and an external stability position, we're sitting in a really strong position. And even though our dollar has fallen, that's driven improved international competitiveness, and it's being offset by very high commodity prices. Now, of course, as those commodity prices normalize over the long term, as hopefully the Ukraine war ends and supply constraints start to unwind, you should expect to see those commodity prices go down because they're at historical highs. But as we said, we should also expect to see our dollar rise a little up to maybe the 75 cents, which will then offset each other to some extent. And hopefully we'll see some ongoing continuation of our current account surpluses. But to be honest, given the fact that this is 13 consecutive quarters, that's very unusual. Historically, we've had a current account deficit. I think we're really still looking at the fact that, maybe post-2025, as we start to see conditions change in Australia, return to becoming a net capital importer, it's likely to see that return to a current account deficit. So there we have it, guys. I hope that is a good deep dive for you on the current state of, the current account. And its components, right, in terms of balance of, BOGs, net primary income, financial, capital financial accounts, as well as also a look at our net foreign liabilities position. If you have any questions, let me know in the comments below. Otherwise, all the best for HSC Economics. If you need any support, we have an incredible team of tutors and mentors here at AUDUSD that can support you for HSC Economics. Don't be shy, get in touch. Otherwise, see you on the next video.